Hey everybody, it's Daniel here from InfoWest. Hope you're all doing well. So we got to talk about the Fed, right? Because we've got Powell yesterday who came out, discussed about a couple of key points that we will go over. And the Fed this week is all out discussing much about monetary policy, including not just Powell but also Fed Moran, which is the possible next Fed chair for next year. So first and foremost, when we look at here the markets and the S&P 500, we are pulling back right now. We did see some shakeout. We did get a pullback after this massive shakeout. Pull up higher in the equities, and then we got a pullback here in the European and Asian session. Then followed by Tuesday, the market open. We just kind of went back to the previous level around the 6,717. And now we did get a move up higher, but we're selling off. Doesn't necessarily mean that it's all over. You could put this however you want, trend lines, whether it matters to you or not. But definitely we do have comments coming out and headlines coming out that possibly have derailed this mini rally that we had in the AM. Anything to be worried about or fearful about? Nothing really. We've got, just because we got this massive shakeout here doesn't mean that we can't get back to price level one and all-time highs in S&P and NASDAQ, right? Especially with trade tensions that are elevated after Trump throwing a bomb but backing off now. But when you look at other markets like the Russell, we've completely wiped out the P1 trade. We are selling off now, but we did surpass that level. Dow Jones, same thing, reached to price level 1, and NASDAQ was getting there, but we got the sell-off, right? So rotation is the key word here. Rotation, even though with the sell-off that we're seeing, you're going to get headlines. You're going to get comments coming out that will derail the markets here and there, unless it's, as long as it's not anything that will change the tone completely going forward. And these are just minor headlines that will eventually be shrugged off that we've been seeing in the markets. Things should be fine. And rotation is the key word here, because you're seeing money more flow into the Russell. That's why you had this outperformance here versus the other indices, because there's fears about bubbles and AI bubbles and other markets being more overpriced. Now, what do I want to talk about with what Powell said yesterday, right? And we had this nice rally that we saw yesterday as well. So these were the key points that I want to bring up and highlight. Basically, to sum up, Powell said that before the U.S. government shutdown, the growth was better than expected, telling us growth is fine. However, data since July meeting shows labor market has softened considerably. Now, it's possible that, the non-farm payrolls report that we didn't get, it's possible that they have information on that already, and that comment, you wonder, is it also a comment to hint about last non-farm payrolls report? So, we don't know truly, but we will see. But the fact that he's made a couple of comments of softening the labor market, downside risks to jobs market have risen, rising risks to job market justify September interest rate cuts, basically saying weak jobs, weak jobs, weak jobs. Tariffs pushing price pressures, worried about inflation there. Recent data point to low hiring, low fire employment landscape. So again, the job market, U.S. Central Bank has other data point beyond government sources to use. So okay, giving you a little bit of a hint there that they have somewhat of an idea of the job market, non-farm payrolls. And there's plausible data for the state of the job market. Again, another hint there. Though private data is the best, is best as a supplement. So, the private data, the ADP, as we saw previously, did show weakness there. So, him telling us about such things, him telling us about the private data being something to look at, makes you wonder that is he also sending us a signal of weakness well, he is sending a signal of weakness of the job data, but the question is how weak, because ADP, as we've seen previously, did pretty bad. So another interesting thing mentioned that may be approaching the end of the balance sheet contraction in the coming months. So this is big, and this is also very positive for the equity markets, that they're going to be ending QT soon, which means that the next move afterwards, after not contracting the balance sheet for some time, is eventually printing money, QE. And that could come maybe next year, if especially, the shit hits the fan and the job market really gets worse off. So you see the sudden signs, the subtle signs that are slowly coming in and prepping the environment of potential money printing, QE, rate cuts, that could really spark a fire in the markets, especially if there's some ugly, recession that comes in. Also says see signs of some parts of the money market seeing tightness, right? Tighter conditions. That's not a good sign when liquidity is drying up in the money markets area. And we do have information where there are signs of it, and it is getting worse off, but nothing to a point where things have exploded yet. See space for Fed to be more nimble with the balance sheet size. Balance sheet remains important monetary policy tool. Again, telling you balance sheet is important, and more than especially even the rate cuts, which will help spark a better, maybe help the economy if the job market really tightens and get worse off. If the Fed moves too quickly, it may leave the inflation job unfinished. So that's a little bit hawkish there, but guess what? We'll have a new Fed member next year, so does it really matter? Data since the July meeting shows labor market has softened, so yeah, we already know that. The fact that unemployment rate has barely moved is quite remarkable. Well, the data can be quite lagging at times, especially the unemployment rate. And the Fed will get access to the inflation report, so we hope to see that soon too. Now, this was Powell. Moran basically came out and said there's downside risk than a week ago, and says that with the change in the balance of risk, urges that to get more neutral policy quickly, fast, get those rate cuts fast. The economy is vulnerable, shocks because of policies restrictive. The difference in his views and the rest of the FOMC is speed. He wants speed. Bring those rate cuts fast. Less concerned about inflation going to the upside. Said difficulty knowing the neutral rate exactly. Uncertain over the level of neutral rate does. Is a debate. The labor market has clearly weakened. Housing has been also affected. 2 more rate cuts this year sounds realistic. Data is backward looking. Policy should be based on where the Fed thinks prices will be in the years, and so forth. So more of a dovish tone, more of let's get those rate cuts in quickly and let's do a lot of them. So you see quite the opposite. Although Powell was dovish on the balance sheet remarks, but still hinting that inflation is an issue, still going slower versus Moran wants that fast move there. So what does this tell us? Is this setting up for the QE money printing next year? It looks like it. More rate cuts next year. It looks like it. And also, according to past history and even what Powell said here, the labor market is weakening. So will we see significant weakness in the labor market next year? It's possible, according to the few hints that we heard from Powell. So anyways, let me know what you guys think. Leave a comment below, subscribe, hit the like button, bell icon to be notified of the next video, and I'll see you guys around. Cheers. Bye.